Welcome to the Major League Real Estate Podcast, a podcast for operators of large-scale real estate portfolios. My name is Nathan Sosa, and I'm your host. Together with my co-host, Matt Hamilton, we talk about tax and legal strategies, and we bring on operators of large portfolios for in-depth discussions on how they grow their business. We hope you enjoy. Welcome back to another episode of the Major League Real Estate Podcast. My name is Nathan Sosa, and I'm joined, at least for the moment, by my co-host, Matt Hamilton. Matt, I won't lie. I think it'd make for amazing content if you'd be like, I have to leave. My wife's going into labor right now. So I kind of hope that happens in the middle of this podcast, but...
she would too, for what it's worth.
Yeah, that's what I'm figuring.
Yeah, no, that'd make for great short form content. You could clip that, throw some animations on it, put it on TikTok, and it'd be pretty sick.
Pretty sick. I mean, are there any since we're on topic, is there any strategies that syndicators can use when they're having kids?
No, I mean, a serious answer. I mean, just have more of them. I guess get more of those tax deductions. Yeah. Have more of them, and have them at the end of the year to maximize your tax savings.
At the end of the year, there you go. That's actually my strategy. I'm having a kid in December, so that's it's going to work out that way for me.
Did you plan it out that way for tax purposes?
So yeah, you plan out for tax purposes, and then you realize that then you have to deal with like Christmas, like kids around Christmas, birthdays around Christmas, and then you realize it's actually not a good long-term play. It's actually a pretty bad long-term play. Yeah, so everyone knows the December birthday, and it's like I love it, but it's like it gets a little dicey.
Yeah, having a kid in December is what we might call having the tax dog wag the tail. Wait, no, that's the right. Tax tail wag the dog. You know what I mean. You know what the saying is.
If you're listening to this, you definitely you know what we're saying overall. But Matt, how's like the anxiety levels right now for you guys? Like I think you've been to the hospital twice, you said already, and that's like to get potentially induced.
Yeah. I mean, for context, my wife is 39 weeks and 1 day today, so. Could happen at any moment. We could have to rush to the hospital, and then I'm going on paternity leave. So it's my anxiety level right now is it's actually lower than it was probably like a week ago. So I feel like pretty at peace. I feel like things are going to happen the way they're going to happen. I really don't have much control over it. So I all I can do is react. So
that's right. Get the go bag packed, snag that pillow. That's all fathers know is the hospital pillows are not great.
Yep.
I think I slept in the recliner. I don't think I actually slept in the bed.
That's nice. The room, the rooms of the hospital we're going to, there's no recliner. It's just a couch, but it pulls out.
Yeah,
like a little
but
cot,
I think isn't that the one that they'll move you to? They'll move you to like a different room at some point. I feel like, probably. Right? Everyone's experience is always different.
We did a tour, and she probably mentioned that in the tour. But there was a lot of information being thrown at me very quickly. So, who knows what's going to happen.
We'll blame it on the fact that you were too busy thinking about recording this episode and talking about 1031s.
That's what I was thinking about the entire time. Yeah.
And so our topic today is about 1030, just like, what is a 1030? Like, I'm sure many of you are aware of what a 1031 is. We'll still talk about that. But also the difficulties in situations you can fix when it comes to 1031s, right? Because a lot of times, 1031s are pretty easy to fix when it's one individual, right? It's like when you got one person who's driving the car, not a problem, right? They get to make all the decisions. When you have multiple hands on the wheel, all of a sudden, making a turn left or right makes things very, very difficult. So today we'll talk through, basically, just on the basics of 1031s, where syndicators run into trouble, what are the top two situations we see that syndicators run into, and then how do we solve those situations, right? Today's going to be a precursor episode. We're going to do a 1031 series once Matt gets back from paternity leave. But we'll do really deep dives into TICs, drops and swaps, all those types of things. So just stay tuned for those. But today we still want to dive in and provide you guys that content. So Matt, in a sentence or more than one, if you need to, how would you describe what a 1031 is and what does it do from a tax perspective?
So a 1031 exchange at a very high level is a system that was put in place by Congress in Section 1031 of the Internal Revenue Code, hence the 1031 exchange. And it effectively allows you to exchange like-kind property for other like-kind property. So in this case, real estate for real estate. And it effectively allows you to roll your tax basis from the original property into the new property. So what that means is, let's say you buy a property for $1 million, you hold it for however many years, now it's worth $2 million. And your basis is still $1 million, and you have $1 million of built-in gain, let's call it. And you sell that property and you take all of the proceeds from the sale and you buy a new replacement property that's generally bigger because now you have $2 million to invest in your new property. But what happens is the new property effectively retains the basis of the original property. So you still have that $1 million basis in that new property. So you're effectively taking your original built-in capital gain and rolling it into the new property that's also going to acquire a capital gain. It kind of rolls that gain forward. You're not avoiding the capital gain. That capital gain still exists. This is purely a deferral strategy. The goal is to pay the tax on that capital gain later. And that's what this exchange allows you to do.
100%. Yeah. A lot of people will get confused with that. They don't realize it's just a tax deferral game, which look, that's it is a strategy for sure, right? You swap so you drop, right? It's basically you just keep deferring. Granted, it's a little bit different when you don't own it 100% yourself. So it's a lot more harder to do that. Unless it's a family partnership, something like that, and you got a bunch of close investors that can make it work that way. Obviously, that's easier at that point in time to pass it down to heirs, but for a lot of syndications, that's not the end goal, is to do that. So 1031's fantastic deferral strategy. What are some of the core rules that come around 1031s? I know a lot of people talk about 45 days, 180 days. How does that work? And then how does that work in a specific partnership context, actually?
So whenever you want to execute a 1031 exchange, there's a lot of hoops you have to jump through. When you sell the first property, you have a set amount of time to identify the new property. And you have to fill out a form identifying the address, the description of that replacement property. And that whole time, the sales proceeds from the original sale have to be held by what's called a qualified intermediary, or a QI. This is effectively, it's very similar to escrow, where this cash is held up by a third party that is basically disallowing you from accessing that cash because it's held for a specific purpose. So you sell the first property, cash goes to the QI, you identify the replacement property, and then you have to close on that replacement property in, I believe is it 60 days? You deal with 1031 exchanges more with individual investors. With LLCs and syndications, it's less common. So it's not fresh off the top of my head.
Yeah, it's 45. Yeah, basically you have 45 days, like Matt was saying. So you have to identify the properties, right? First, you got to identify the properties. Do that in 45 days, and then that fall you have overall all the deadlines that happen have to fall within a 180-day window. So you got golden handcuffs, I like to call them, because you have to move rather quickly. So you have to basically have identified all these properties at the beginning of the process. And so now, with one person, like I said earlier, when it's one person driving the decision, much easier to determine, hey, I want to look at these 3 properties, right? While if you syndication, you have to now think about, is that investor going to be okay with this? Is this investor going to be okay with this? Is that investor going to be okay with this? Right? There's a lot more for being a syndicator. You have to pull in and kind of pitch. It's hey, we're not just going to sell. And here's the kicker. You're not going to get any cash out of it, right? You're not going to get any cash from the sale. So that's what makes 1031 super difficult, and actually very niche scenarios that happen ultimately. Because when you have a sale of property, a lot of investors say, I want my cash, or I would like to see my cash now, right? I would like to see my return. You go, no, we're just going to put it in another property. You're going to get more returns. And you go, some people are patient, some people are not patient, some people have needs, and they go, no, I need cash now. That makes it difficult then, because you can't go through 1031 because then you'll have boot. And boot because if you go through that process and you distribute cash out, guess what? Taxable gain to the partnership. There might be ways to work through that, but that's just kind of the core of it overall. There's a couple different types of 1031s. There's the standard one where you just you sell your property, then in 180 days from that sale, you have to go close on the property. There's a reverse 1031 where you first acquire the property and then you kind of walk yourself backwards from the whole process. And so you buy the property, then you walk yourself back with that. There's also build to construct exchanges. Those are very, very complex. They can be really, really powerful, but they are very, very complex. Involves a qualified exchange accommodation agreement with an exchange accommodation title holder, which is called EAT, right? A QEEA and an EAT, which is a lot. And the hard part with the improvement exchange, another word for it, improvement or build to construct exchange, is you have to still accomplish everything in 180 days. If you're just doing improvements, that's not that difficult. If you're doing a construction, I've never seen a property go up in 180 days, Matt. Now, granted, it's more about how much funds and equity you've put into it ultimately. So it doesn't necessarily, it can be in WIP, But still, that's not easy to do a lot of times. Like, honestly, have you ever seen any succeed in your practice?
I've never seen one attempted in my practice, in all of my experience working with these 1031 exchanges, and even regular 1031 exchanges with a lot of the complications you were just talking about earlier. They're relatively uncommon in syndications, just because oftentimes the goal of a syndication is to acquire a property, improve the cash flow, pay the operating distributions from that cash flow out to your LPs with the intention of selling that property in a set amount of time, let's say 3, 5, 10 years, whatever that time horizon is, and paying out that cash to all your LPs, so they're receiving a full return of capital plus whatever return. They're in it for the cash flow and the return on their investment. Whenever you go to do a 1031 exchange in an LLC, you're effectively sacrificing that cash flow for future cash flow. And the issue there is that, yes, you're deferring that gain, but you're not avoiding it. You're just deferring it. So now your investors are receiving less cash now with the promise of more cash later while paying the same amount of tax. Whereas a lot of your investors might say, well, I'd rather have the cash now so I can take that and invest it in another syndication, unless they're really optimistic about this replacement property and this new deal and they just want to stay invested. There's a lot of hurdles to overcome as a GP, especially when a lot of operating agreements are written in such a way where a liquidating event where you sell the property might trigger the ability for LPs to leave the partnership. So it might be an uphill battle to convince them to stay and keep their capital in the LLC. Maybe you need to raise more capital to make up for the funds that are leaving, and now you have a situation where you might be recognizing gain on the 1031 exchange anyways. So it's what we might call a failed 1031 exchange, where you're still recognizing most of that gain. You're not really deferring much of it. So there's a lot of considerations and a lot of complications to overcome when you're trying to execute a 1031 exchange within a syndicated LLC when you're going into that replacement property. Like I said, it's relatively uncommon.
Real estate syndication tax is confusing to you? Well, that's why hopefully you listen to the podcast today. Also, you should go to our website, www.therealestatecpa.com, and you will be able to get access to the ultimate guide to real estate syndicators and sponsors, which breaks down everything from preferred returns, depreciation strategies, whether you're a GP or an LP, avoid costly mistakes, and maximize your returns. Download the complete guide free and get the tax clarity you need to succeed.
Right. Something Josh when I was mentioning about the failed 1031 exchange is also that failed 1031s have a weird quirk that you can potentially elect to recognize. Like if it crosses tax years, for example, which can happen. It's actually more common than most people think it is, where you almost get to pick and choose when you recognize your gain. You can choose to either do it in, like, let's say we're 2025 and it crosses in 2026. You can choose to do the installment method, report it in 2026, or assuming it fails, or you can choose to elect it 2025. It's very situational. That's why you got to work with someone close who can help you figure out whether that makes sense to do that. So, hey, again, check the show notes if you guys want to work with us or have any questions, right? So, like, our socials are in there, therealestatecpa.com. You guys can go there as well, too, if you guys want to work with us as you're going through these types of situations. Because if you try to execute 1031 without a tax advisor, you're going to run into a lot of hiccups and a lot of problems that you're going to have a lot of questions from your investors, too. So, this is not a transaction I'd go alone with, just FYI. So, saying that, Matt, what are like the most common situations? I mean, actually, you had a situation this year where someone was doing a 1031 and they're looking to actually raise capital first. You want to talk a little bit about that situation, and then we'll talk about the other ones?
Yeah, absolutely. So this situation is actually one of the two most common situations I see with 1031 exchanges. This one is far less common than the other one that we're going to get into a little bit later. But with this scenario specifically, the client had an LLC that they were wanting to do a 1031 exchange where they sell the property that the LLC held in exchange for a larger replacement property. But the issue, there were two issues. The first issue was they didn't have enough cash to close on the new property, so they needed more investors. And they had investors lined up that were willing to invest more capital, contribute more capital into the LLC to close the deal. And the concern they had was, well, if we change the ownership structure of the LLC, does that invalidate the 1031 exchange? Can this LLC still do this 1031 exchange? So the short answer is yes, because the LLC is the taxpayer doing the 1031 exchange. The ownership structure, so long as it doesn't become a disregarded entity, a single member LLC, or substantial ownership changes like that, just changes in LPs, more LPs coming in, capital contributed. Like that doesn't really matter in the grand scheme of things when you're trying to execute this 1031 exchange. So they were able to raise that additional capital and close the deal on this replacement property. So it worked out for them. But one of their other concerns was that some of their partners weren't going to be thrilled with the 1031 exchange. They wanted out. They wanted their cash distributed them from the actual capital event, the initial sale of the relinquished property. And that's going to create issues, like you said, Nathan, where kind of going back to a very simple example, let's say you're one investor and you're doing a 1031 exchange and you sell this property. The point is to take all of the sales proceeds and deploy them into the replacement property. To the extent you sell the property, let's say you buy it for $1 million, going back to the first example, you buy it for $1 million, it's worth $2 million, you sell it for $2 million, you want to deploy all $2 million into the replacement property. But what if you have some sort of expense, maybe a tax bill, and you're like, well, I'm just going to pocket $100,000 from this sale and then deploy $1.9 million into the new property? Well, that's going to create gain. Now, because you pocketed $100,000, you have to recognize $100,000 of gain on this sale. So going back to the example with the LLC has to pocket some of that cash to pay liquidating distributions to their investors. That's the exact same thing. So now the LLC has to effectively recognize that gain on the portion of the cash that they pocketed to distribute to their investors. So that creates an issue where there's a gain recognition event. So that's just something to be aware of. And when you're working with your tax advisor, your CPA to structure this deal, it's possible to kind of work around this a little bit and make sure that the gain being recognized is allocated to the beneficiary of that gain recognition, the one receiving the cash. And that could allow your other investors, it could shield your other investors from that gain recognition. It effectively makes the 1031 exchange work for those involved. But like I said, that's a very complicated, nuanced situation. It's very important that you go into that with a tax advisor and someone on your side to kind of walk through those steps to make sure you're doing all of that above board the way it needs to be done.
Yeah, it's like you mentioned already. It's super complex. And like just kind of to recap, basically it's that you need cash. The income needs to follow the cash, right? Just like as we talked about with our a couple episodes ago, substantial economic effect, right? And like overall, like the whole point of a 1031, the way the government's kind of structured it, and like honestly, the reading the tax code is to say, hey, if you keep your money in these types of assets and they don't actually come into you to your bank account type of thing, they go, great, you'll never get taxed on these, right? That's why they keep deferring, because it's like basically saying like the money never came back into the economy, never returned to you. So that way, that's why you can keep utilizing this type of a tool going forward, right? Whether that's good policy, not great policy, you figure like I'll let everyone make that decision, but that's essentially just the way it's meant to be. So whenever you keep deferring your gain, keeping your cash out, then great, probably not going to get taxed. But whenever you do have to look at getting some tax, you have excess funds, etc. Unfortunately, that's like, and like, isn't that a common issue that you see a lot, Matt? It's like basically like they don't have enough equity to get into the next property, so they wind up having gain anyways, or don't get enough debt. Is that something you commonly see as well?
Yeah, bridging that gap between the relinquished property and the replacement property is a common issue because you have to bridge that gap in a way that doesn't create gain.
Yeah, break down that. And so what is that gap? Let's break down that gap. What does that gap mean? And like, I guess specifically, it's like, how is that gap created? And then how do we solve for that?
Yeah, so that gap, very simply, going back to the initial simple example, you have a property where you bought for $1 million, sold for $2 million, you deploy the $2 million of capital into the new property. Great. What if that replacement property is not worth $2 million? What if it's worth $4 million and you have $2 million of capital that you need to deploy into this new replacement property that's worth $4 million? You have a gap of $2 million. And the LLC or the individual, whatever taxpayer is executing this exchange, has a couple options. They could leverage the other half of the proceeds. They could borrow money in the form of a mortgage or whatever debt that may be. They could raise more capital. They could go out and syndicate the rest of it and raise additional capital from investors. But in some way, they have to bridge that funding gap.
Yep. Basically, you have to bring more in some form or fashion, whether it's your cash or someone else's cash. You got to like make up the difference. And actually, something else people don't think about a lot too when it comes to 1031s is the rollover basis that happens here. So a lot of times, so like you just scaled up to a $4 million property, like, right, you sold $1 million, you sold for $2 million, but it was $1 million acquisition price. Guess what? you only get new fresh basis of $2 million of new cash in this instance. So that means when you do a cost egg, you're not going to be doing a cost egg on $4 million. You're going to be doing a cost egg on the new $2 million. Now you still have an old $1 million that's sitting there, right? You kind of like, I don't say you lose $1 million of basis, but the way the tax code is written, the way it's supposed to work is that you don't get new basis for that $1 million, right? So that's so just FYI there is that like when people expect, oh, I'm going to get massive depreciation deductions. That's not how it works, unfortunately. So just an FYI on that piece. So Matt, you broke down that one common situation. What's the other common situation that you run into? And I believe it's ticking time bomb is what you see a lot of times.
Yes. The elephant in the room when it comes to 1031 exchanges and syndications, TICs, or tenancy-in-common, or tenants-in-common. Really high level. Tenants-in-common is when two different people, or two different taxpayers in this case, both jointly own a single piece of real estate. So if you were to look at the deed of that property, there are multiple owners. And this is very common in real estate as a way of two different people or two different entities, two different taxpayers jointly owning the same piece of real estate in a way that doesn't form a partnership or create an additional tax filing. This could be done not just for 1031 exchange purposes. This could be done for just for joint venture purposes if two people are looking for a way to avoid additional paperwork, additional tax filings. But how we see this in the syndication space has to do with 1031 exchanges. And going back to the very beginning of this conversation, a 1031 exchange is called a like-kind exchange, meaning that you have to exchange like-kind property for like-kind property, in this case, real estate for real estate. The issue is that if you, as an individual, sell your real property, so you relinquished real estate, you have to replace it with real estate. An LP position in a partnership or a partnership interest as an asset is not real estate. Even if that partnership owns real estate, you do not own the real estate. You own a ownership interest in the partnership that owns real estate. Real estate and partnership interest, those are not like-kind properties. You cannot 1031 exchange your proceeds from real estate into a partnership. So what happens a lot, I have clients bring this up to me relatively frequently. They say, hey, we're trying to close on this new property. We're setting up the LLC. We've raised X amount of capital from all of our LPs, but we have this one investor who says he's ready to invest $1 million into this property, but he's doing a 1031 exchange. Can he 1031 exchange that $1 million into an LP position of this partnership? The answer is no. Well, he could, but it wouldn't be a 1031 exchange. He would have to recognize all of the gain from that sale immediately. The only way to 1031 exchange your proceeds into the syndication would be for him to be on the deeds specifically. That investor has to be a joint owner of the property via a tenancy-in-common, which sounds simple on paper, but you very quickly run into a lot of complications. And the issue is a lot of people like to create a tenancy-in-common and just sort of treat it like a partnership. And the IRS has taken the position that if it walks like a duck and quacks like a duck, it's probably a duck. So if you have a tenancy-in-common and it acts like a partnership, you really run the risk of the IRS coming in and saying, this is not a TIC, this is a partnership. You need to file a return for this partnership, and so-and-so's 1031 exchange is invalid, and they have to recognize that gain and pay a bunch of back taxes for not recognizing that gain immediately. So the IRS has actually released guidance in Revenue Proclamation, or RevProc 2002-22. It's basically a list of all of the things that TIC needs to adhere to in order to be treated as a TIC. And we can dive really deep into that RevProc specifically on a future episode, because we could go on for a long time. There's a lot of things on that list, but it's just really important to be aware for this conversation. It's really important to be aware that if you are structuring a deal as a TIC in order to bring in a 1031 exchange investor, it's really critical that you structure this deal with an attorney, maybe even with a tax attorney, to make sure that you are adhering to everything that needs to be done in order to make sure that your T's are crossed, your I's are dotted, and the IRS cannot say that this TIC is a partnership. Because we've seen some of these TICs get audited, and there is a lot of documentation you need in order to win that audit. It is a uphill battle. So you really need to make sure that you're going into that with everything you need and everything above board in order to guarantee that you are remaining in compliance with tax law.
Yeah, TICs are not like, a lot of times people are like, oh, it sounds like I should have joint ownership, right? That's all I need. We're good. Yeah, and it's not. If you break any of the rules involved, you become a partnership. And guess what? And it's like, okay, so now, like, and then you're like, okay, that's not a big deal, right? Now you're a partnership, fine, no big deal. What if you had that TIC for 3 years and you filed 0 partnerships, right? Now that's a lot of late filing penalties that are stacked up when you should have filed. And the IRS will go back and they will go get you for those penalties. Like
Yeah.
I'm not like, and everyone's talking about, it's like, well, IRS doesn't exist anymore, right? It's like not that many employees. And like, yeah, that means they're like in these situations, they're not going to allow leniency. They're not going to be like, oh, it's okay, you messed up, right? Like, that's not going to happen here. And so just an FYI is that, like, look, you got to live and die by TIC rules. And so they're laid out. We have the rules. They're not easy, but you have to live by them in this instance. And so another thing I want to mention too is when it comes to these types of transactions is like, you have to have business intent, right? Business or investment intent. And so there's a couple court cases from way back when that are still, I don't want to say combated by the IRS, but they like cause questions with the IRS, by the names of Magnuson and Bolker, basically where someone had a property and then immediately took it out of a property, put it in another partnership or something like that. And so we always have to be very cautious with those types of transactions because we have to prove business intent at the end of the day. We have to prove that the intent wasn't just for tax deferral purposes, but there's business intent, etc. There's flexibility around those, and we'll dive into that in a future podcast. But there is opportunity here to still obtain and follow that business intent. But the safe harbor is going to be what Matt suggested, right? And so like where we have the TIC structure with the partnership, it's achievable. It does have legal costs, but hey, if you have $1 million of gain you're trying to defer, I think you're going to win out on those legal costs at the end of the day, in my opinion, Matt. So those are some common situations we see and how we have solutions for those. Look, there's a lot of other things too, right? There's drops and swaps. Brandon and I are actually going to jump into a tax court case while Matt's on paternity leave. It's not a I say tax court case. It's a New York case, but it was a drop and swap that was successfully defended. New York follows the exact same 1031 rule. So we'll dive into that kind of stuff too. Unlike dive into the tax case, but there's also deletour statutory trust, lazy 1031s. There's a lot of opportunities here that we can use to work through all this stuff. So there's a lot of options out there that we can use. Again, you got to work with someone that knows this stuff and knows it well. So that's why I highly recommend clicking the show notes below, checking out some of our content online, and then maybe clicking the link to work with us and be a client, right? So again, it's at www.therealestatecpa.com. Matt told me that I have not been saying the CPA.com, so I hope some of you got halfway there and figured out what I was saying. But check the show links below. Everyone, please wish Matt a happy paternity leave. I'm not going to say hopefully, but probably going to be the last podcast for a little bit from him before he gets back from paternity leave. And then also in the future, guys, if you want to, please submit questions to us. We'll have a link in the show notes, just like a Google form that you can say, hey, what are your biggest questions for syndications from a tax perspective? And we'll jump on and answer those for you, kind of just like a mailbag, MLRE mailbag going forward. So whether you're a syndicator, tax professional, shoot those questions over to us. We'd love to answer them. But everyone, thanks so much for listening today. Check the show notes and wish Matt a happy journey on his paternity leave.